Hey, welcome back. My name is Steve Stump. You are listening to the Health Insurance 411. And today I want to talk about deductible based plans and what they are doing to damage the health insurance industry and hurting so many Americans nowadays. You know, over the last decade, deductibles have continued to increase and they have more than doubled in the last decade. The median average or the median deductible for uh, families nowadays is $8,439. That's a lot of money that a family must pay before they get any health benefits from the insurance that they pay for. You know, I was reading an article and the author did a really nice job. And the analogy he used was if you were to buy a monthly subscription streaming service and then you had to go pay more money to watch the movies on the streaming service that you were paying the subscription for, would you be interested in a streaming service like that? And of course, if we were paying for a streaming service, we'd want to get some more value and not have to pay for every movie or television show that we stream from that service. But health insurance is different. You actually pay for health insurance, and then you have to share a portion of your healthcare costs throughout the year, reaching your deductible. And then you have a co-insurance rate that is going to reach an out-of-pocket maximum limit before the health insurance company will pay 100% of your benefits. And those deductibles have doubled over the past decade and have reached over $8,000. Well, in 2019, the Kaiser Family Foundation actually wanted to take a look and see how long within a year does a family have to wait before they get that deductible break-even point. And so they reviewed healthcare expenditures throughout the year across all the different plans and healthcare options that are our health insurance options that are out there. And they came to the conclusion that the majority of the insureds don't reach their deductible until the middle of May. And this was 2 years ago. My guess is if they were to rerun that study again, we would be in June, maybe all the way through half of the year before families are reaching their deductibles. So this is really quite concerning that the insurance industry seems to be able to just keep putting the burden on the insured to share the cost of their health care. Well, they do this because they believe that sharing the cost of your health care actually lowers the cost of health insurance and health care for everybody. The health insurance companies actually look back at a study that was done over now 50 years ago. It was in the 70s, where they found that when individuals had to share the cost of health care, that they forego or did not take any health care needs that were unnecessary, therefore lowering the cost of healthcare across the entire industry and across all the insureds. Well, in reality, what people are doing is they are now motivated not to care how much their healthcare cost. So what I mean by that is if you are on a deductible based plan and you have a co-insurance rate that you have to pay to reach an out-of-pocket maximum limit, and you're not going to reach your deductible till May or June, then you actually don't care how much your healthcare costs, because you want to reach your deductible as fast as possible so that you can get some benefit from your plan at the co-insurance rate. And then again, you still don't care what your health insurance may cost because you've got an out-of-pocket maximum limit that you want to reach so that you can get 100% of your benefits. This is why you hear so many doctors and so many surgeons talk about how busy they are in the fourth quarter, because people are getting to the end of the year and they've been putting off some major procedure or major healthcare need. And now they've got to get in and get that healthcare taken care of so that they can get some benefit from their plan before the beginning of the year when everything resets. One of the options that people have is private insurance. And with private insurance plans, these plans are structured as a first dollar benefit plan. You can think as a deductible based plan as a second dollar benefit plan. What I mean by this is with a first dollar benefit plan, the plan pays before you do. And then you pay any difference between the amount that the plan pays and that cost of care. Structured the right way, though, these policies can actually reverse that situation so that the cost of care is actually lower than the benefit, and therefore resulting in no cost to you or maybe even excess benefit paid back to you. Now, with a second dollar benefit plan, which is primarily what you see with deductible-based plans, you are paying before the insurance company does. You see, you are paying 100% of the cost of care up into your deductible, and then you're sharing part of the cost of care at your co-insurance rate up into your out-of-pocket maximum limit. And so in these situations, you are actually paying a lot before the insurance company does. I actually talk about this a lot in my video where I explain how the health insurance industry and healthcare industry is actually rigged against you, but you can rig it in your favor with these first dollar benefit plans. If you haven't checked it out, you got to do so. And again, if you haven't liked or shared one of my videos, please do so, because this is how I reach more and more people with such valuable information. So I appreciate you tuning in today. Stay tuned for the next episode, because I look forward to sharing more information with you. Have a great and fantastic day. You've been listening to the Health Insurance 411. And again, my name is Steve Stump.